morning. My name is Steve Kenny. I am the Commercial Director at Square Mile. And on behalf of my colleagues at Square Mile and ESG Clarity, a warm welcome to the second ESG Pathway. We have a fabulous event for you today. This is the second in the series of 4, and I'm delighted that so many of you have joined us again after the first session. The events have been put together by Square Mile and ESG Clarity and are designed to be both informative and provide some practical guidance on how to address the ESG challenge. The first event provided some very useful insights in how prepared advisors are and also what they expect from asset managers. 82% of those surveyed in the first event have taken steps to integrate ESG or responsible investments into their centralized investment proposition. This is significantly up on a survey that Square Mile conducted while attending the Q1 PFS roadshows, where that number was just over 50%. So a definite increase in the preparedness of the industry. The second interesting point when asked, where does ESG start at an asset manager? 75% of the audience felt it was a cultural thing. It was the firm's DNA. So not just a marketing gimmick or led by investment managers, far more part of the DNA of the business, the culture. And this ties into something the FCA highlighted a couple of years ago, where the cultural aspect of a business was so important. It drives how a business behaves. And in the view of the advisor community from the first session, that is definitely true of ESG. And thirdly, the growth in the popularity of this area was evidenced by a recent survey stating 25% of the new managed portfolio services launched this year were branded either responsible or ESG. So we have a situation where the opportunities and the solutions in the market have increased quite dramatically. We also have a plethora of new funds being launched to meet this need. We have a genuine change in societal appetite in terms of their buying behaviours. And there is on the horizon potential regulatory change. But undoubtedly, the momentum in terms of responsible in ESG has picked up quite markedly. And that is evidenced by fund flows from the recent Investment Association press release, the press coverage, not only in the industry press, but in the mainstream press, and the interest in events like this from advisors, where the numbers are quite marked in terms of how many people are attending. Today's session looks to provide some thoughts on one of the reasons heralded for this increase in momentum. Has the pandemic accelerated the adoption of sustainable funds? To do this, we have a super agenda with 2 interactive sessions, and we do want you to submit questions. Now, to check the system is working, I'm going to give you the opportunity to decide who will win the US election. A simple question: will it be Joe Biden or will it be Donald Trump? Now, the question should appear on the side of your screen, and I would encourage you to vote, and I'll share the results in a minute. On today's agenda, we have an advisor panel to provide practical advice on how they have embraced this change in appetite, how they've dealt with it from a practical session. This session will be hosted by my colleague, Jake Moeller, with 3 advisors whom he'll introduce presently. We then have some pre-recorded videos. Ask the expert. 3 advisors have submitted a video question that we answered by the experts from 7IM, JP Morgan and Schroders. We are still looking for a couple of questions. Do not be shy. Please take the opportunity to submit your pre-recorded video questions for this section. It is your chance to ask an expert from the asset management community and help your fellow advisors on a topic they may also want to know about. And not surprisingly, the results are just in. 28% think that Donald Trump will win, 72% think that Joe Biden. And that very much is reflected in terms of the betting, in terms of the odds that you can see in the marketplace. So I'm pleased to see that we do think the Democrats will be taking the presidency. So practical examples there from the advisor community. We've then got the platform perspective. We have Jenny Davidson, Head of Platform Investment Solutions at Standard Life, on how the platform will deal with the challenge of providing advisors with the information on ESG, which will be required for the end client. This will be followed by a session chaired by Richard Romerly, the MD from Square Mile, with 3 representatives from the asset managers Aberdeen Standard Investments, Invesco, Janice Henderson, and they'll be tasked with answering the question, has the pandemic accelerated the move towards responsible investing? And finally, the session will be brought to a conclusion by Natalie Kenway, the editor of ESG Clarity, providing a summation of the key points from today's session. Now, some quick housekeeping. The event is being recorded. You will all be on mute. Questions and feedback should be via the side of your screen, so please do take that opportunity. The event does qualify for CPD, and your part in today's event is welcomed. Please do submit your questions. Ultimately, we want to take the opportunity to provide you with as much information as possible or practical anecdotes from our panelists that will help you in challenging or dealing with the challenge of the ESG pathway. A final poll from myself. There is a number of commentators who believe the audience for responsible investing is millennials. I'm open-minded, but to give some context to the next session with the advisors, can I ask you to vote? What's the average age of your clients? Now, if that's too broad a spectrum, can I suggest that you think about your top 20 clients by value? What's their average age? Before I pass over to Jake Moeller, I'd like to say a couple of quick thank yous. Firstly, to you, the audience, for joining us today. We know that you are time poor, and therefore we'd welcome the fact that you've joined us today. And secondly, to the 12 sponsors, 6 of which you are hearing from today. 7IM, Aberdeen Standard, Invesco, Janice Henderson, JP Morgan, and Schroders. The other 6 you'll be hearing from in coming weeks are Aegon Asset Management, AXA IM, BNY Mellon, Federated Hermes, Jupiter, and Elgin. And on behalf of myself and ESG Clarity, many thanks to these sponsors. Without their support, this event would not be possible. Now, I see that the system is still calculating the average age, so I'll pass over to Jake, who will share with you the answer from the audience as he goes through his advisor panel. So, Jake, over to you.
Thanks, Steve. It's great to be here for our second ESG Pathway event. I'm Jake Moeller, Senior Investment Consultant at Square Mile, and now we're going to jump straight in with 3 excellent advisory consultants who are going to take us through the first session. May I introduce James Lawson, who's a partner and co-founder of Tribe Impact Capital, Andrew Watt, who's a director at Watt Money, and David Lloyd Thomas, who's managing director at Thomas & Thomas Ethical Investments. I'm going to jump in with the first question, and Darren, I'll get you to start on that one. The name of the sessions today are ESG Pathway, which I think intimates a journey. Could you tell us a little bit about your advisory group and the background behind it, so that we get a flavour for the kind of clients you deal with, but also talk us through where you are on the journey and how responsible investing became important for your business. Darren, could I get you to start on that, please?
Yes, certainly. Good morning, Jake. We're down here in West Wales. I'm the son of a Baptist minister. And so 22 years ago, when I started giving financial advice, as it was then before it became financial planning, I had some clergy that I started advising. And so I suppose that's where my journey towards ethical investing started. But it wasn't until about 5 years ago when we really challenged ourselves as a firm in regards to, could we offer more of a centralized ethical approach to investing for our clients? At the time, we had about £1 million funds under management in purely ethical portfolios. 5 years on, we have over 30 million, and our swing has gone from sort of having 10% of our client bank in ethical to over 60% now in purely ethical portfolios. It's been an amazing journey, and one that we've greatly enjoyed.
Andrew, before I get you to jump in, I'll just quickly announce the results of Steve's poll. The average ages, so we've got 76% of clients there are 56 years old or more, and 21% are 46 to 55, and small residual amounts in the 25 to 35 and the 36 to 45 bucket. So millennials probably not being a huge amount of your client base at this current point. Okay, sorry to interrupt there. Thank you for that, Darren. Andrew, could I get you to jump in, please?
Yeah, good morning, everybody. Yeah, entered the industry, this wonderful industry, in 1985. This is all about ethics for me. Sat on the investment committee at Scandia where we were advising IFAs on portfolio construction, heard about Friends Providence Stewardship Fund, Jupiter Ecology, run What Money now for 18 years, and trying to educate our clients of all ages, because I do get this point about the millennials kind of may have a view about ethics, etc. But we formulated 6 portfolios beginning this year. We look after about 30 million, of which only at this point, I stress only because I'm on tilt in this balance, we're about 4 to 5 million in our ethical portfolios. And that journey for me will be never ending. So it's an education piece. So I'm delighted to be on this journey, delighted to be speaking to the audience today.
It's interesting that ethical investing seems to be the start for the two of you. James, can tell us a little bit about your business and how you started your journey.
Thanks, Jake. So I'm one of the co-founders of Tribe. Tribe is an impact wealth manager, which means we only run portfolios for impact or ethics or sustainability, whatever we're going to call it today. But broadly, every single one of our mandates has a instruction for us to achieve a financial return at the same time as a positive social or environmental return. It is a journey. We work with clients and with advisors, but ultimately we need to recognise that it is a journey, and what was great a few years ago probably isn't the best now, and what we're doing now probably isn't as good as what we're going to be doing in the future. And so we're delighted to be on this journey with the panelists and some of the audience here today. But as I say, Tribe, all we do, we only run sustainable mandates.
We're going to quickly go to another poll question. In 2020, what percentage of the clients you have met virtually or in person have asked about responsible or sustainable investing? The answers are more than 10%, more than 20%, more than 30%, and more than 50%. If you can have a think about that and put your answers in, please. Can I ask a practical question, again, starting with you, Darren? Have you changed your attitude to risk questionnaire at all or to reflect this nature of your business? I suppose for you it was probably already deeply ingrained.
Yeah, we're pretty well established with this now, but you know, since we launched 14 years ago, we've always had 5 aspects of risk for our clients, 1 being cautious, 5 being very adventurous. What we worked out when we launched our main ethical offerings was that we had to lob off level 1 and level 5. And the reason behind that for us was that we were a bit uncomfortable with, could we really deliver a truly cautious aspect? And also, actually, at the other end, could we really be confident in the emerging market and Asian space enough to deliver what we were promising to our clients in terms of ethical screening parameters? So we have had to adjust a bit. The other thing is every quarter we have to back test and reassess our portfolios for our clients, because that beta can shift around a little bit more.
Thank you. Andrew?
Yeah, this is a really good point, this asset allocation point, because I think it used to be considered that all asset classes couldn't really be taken care of in the ESG space. We're a dynamic planner. We moved to a dynamic planner about a year ago. And so we run 6 risk-rated portfolios, and our investment committee is sitting later this month to look at the constituents of the current fund managers in there. But I think the whole community has got to get over this. If there's any doubt about all asset classes cannot be catered for in an ESG way, they're wrong. So I think as an education piece to the industry, we need to remind clients and asset managers and all the parties to this ESG journey we're all on, every asset class can be catered for. So we run 6 risk-rated portfolios, looking at every asset class.
Do you find enough on the fixed income side? Do you find enough product?
Yeah, absolutely. Yeah, I think all the big players, sorry to interrupt, all the big players have got fixed offerings, and there's enough out there, and it's growing all the time. And climate bonds, etc. There's a lot happening in the fixed market, as I'm sure the audience will appreciate.
We'll come back to the product providers a little bit later, but some interesting feedback there. James, some comments from you?
Yeah, I mean, I'd agree, I think, with Darren, that if you tried to do this a while ago, maybe 20, 30 years ago, it would be hard to find a product across the risk ratings. But right now, as Andy says, it's absolutely possible. And in fact, the recent performance, which we'll talk about that later on, has shown that you can do very well in a sustainable mandate across the risk spectrum. You asked, though, Jake, about that initial client engagement, which obviously for us, on our bespoke side of the business, we spend a lot of time there working with a team of behavioral scientists to get people to articulate what their values are, because we're building customized portfolios. And that's great fun, because it's a really in-depth conversation with clients where you're starting to ask the question, what are your values? Which is an odd question for anyone in finance to ask, but actually it's quite an interesting one. The bit that I think is important for the advisors perhaps listening to this is they will have often introduced this conversation with, what do you want to avoid? Question. And in a sense, it's an easy question to ask, but it's an odd question to ask, because the obvious next thing is, okay, you want to avoid tobacco, but why do you want to avoid tobacco? And you want to avoid tobacco because it's harmful. Well, is there a solution to this harm? Well, there is. Actually, there are businesses that are investing in early cancer treatment or general healthcare, well-being, whatever it might be. So what we would encourage advisors to do is to, when they're looking at that risk questionnaire, and asking about the ethical considerations, maybe to pivot away from what do you want to avoid, i.e. what's the problem, and actually what's the solution to that problem? Because there are lots of brilliant companies trying to solve those solutions, and we think those are the businesses we should be investing in, rather than avoiding the businesses that are producing the harm.
I'll just quickly go to the poll results there from the last poll. What percentage of the clients have you met virtually in person that have asked? More than 10% is 69% of you. More than 20%, 12% of you, and more than 30%, 14%. So a good proportion there. Can I ask a little bit about your CIPs? How have you squared the need to personalize the responsible needs of a client with the need to formulate your CIP? Darren, I'll get you to start on that, please.
Yeah, it's a really good question, Jake. And in fact, that was the big stumbling block for us. And actually, if I'm being honest, to my fellow IFA colleagues, I think it's the thing that holds us all back, because we're all trained when we begin this that, one man's ethical or responsible isn't the same as another person's. And I'm not so sure. I think that, as James is saying, there are positive solutions out there that everybody kind of likes. It's just about trying to pin down what those are. So for us, what we did was we designed our Thomas & Thomas ethical portfolios. We made it very clear then what we would screen out and what we were trying to achieve. And then we offered those to our clients. We also offered a bespoke service, but we offered this as our main kind of offering. And we were just amazed at how many people said, yeah, we'll take you up on that. We like that. Now, absolutely, for many people, they might say, okay, I noticed that you're not absolutely screening out perhaps non-sustainable forestry, because that's quite hard to get rid of, or maybe nuclear power. But having said that, I'm going to come along on this journey because there's enough other things that I really like what you're doing here. I think it's just about being honest about what you're delivering, being very clear.
Andrew, how have you formulated your CIP?
Yeah, reading the FCA guidance a couple of years ago, when we knew what was coming, and apart from that, it's an ethical thing about recommending funds that sustain and help the planet, etc. We formulated questions with our friends from Lion Trust, who we support within our portfolios, and we kind of use these questions as a starting point with client interaction, and then we discuss, and then we formulate the risk assessment, and then they go into one of the 6 portfolios. But it's all about education, and we're on a journey, we're on a transition to get to run an ESG only practice. But I think, as one of my colleagues there said, one person's ethics are not the same as someone else's. There's so many facets to this whole investing ESG piece. So I think we're on that journey to formulate. Just as an aside, I looked at Quilters. Quilters have an ESG questionnaire, which is vast. So it looks at all the areas. So it's a question, I think, from an advisor perspective, it's how far do you want to go with that conversation and what you actually get from the client. So we've started with 3 questions, which really prompts the conscience, and then based on how that conversation and evidence goes, they go into an ESG portfolio or not. So,
James?
Yes, I'm picking up from Andy's point. So there's what's the right portfolio in terms of understanding the client, and then what investment proposition do you have to deliver it? And for us, we have a chief investment officer and a chief impact officer, and both of those 2 teams have right of veto over any investment that we're looking at in order for us to be able to put our clients into it. And what's interesting is that both of them have the same philosophy. Investment philosophy is to find well-run businesses solving big problems. Often when we're working with families, and other advisors might have found this, the older generation will want to spend time with the chief investment officer because they understand the investment rationale, the logic behind why wouldn't I want to be in these businesses. And the younger generations will want to spend time with the chief impact officer. Of course, the business of the future, what is the world going to look like in 20 years when I'm probably not going to be able to buy, I'm not going to be able to buy a new petrol car. So how can a chief impact officer help understand and frame what the investments of the future, business of the future should look like? So I think it is, both Darren and Andy have said, that having some kind of consistency that you can say, actually, I'm not having to make huge changes in either the way that I think or talk to my clients, or actually the product I'm able to deliver my clients. If I can provide something consistent and stand behind it, that's what we want to be able to get.
I'd like to ask each of you a little bit about the client experience. How have you found clients when the subject of responsible investing is raised, and to what extent have your clients raised the issue? I suppose for you, Darren, with your pedigree, it's probably something that's mutually assumed will be part of the discussion, but could you just talk us through that client experience?
Yeah, no problem at all, Jake. In absolute honesty, for many, many years as an IFA, my kind of process was probably very similar to my colleagues watching today, which was, let's talk about financial planning, let's talk about risk, and then kind of right at the end of that, we'd go, well, did you want ethical? It's really good, but it's a bit risky. And so that was kind of our approach. And I think that's because you've got your compliance head on and you're trying to make sure you run your business correctly for your clients. So when you spin that round and you start asking about, you take people on an investment journey, and you're a discovery about themselves, as James was describing. So both James and I follow Gavin at Worthstone, Gavin Francis, and I've been through the ACT qualification with him, which I highly recommend, actually. And what you do on that is you go through the journey of helping your client understand what it is they want. And that is just a fascinating experience, because it gets you away from just profitability, just numbers. And it's much about what matters at their heart of how they're investing. Having said all of that, Jake, after putting in all that work, honestly, I'd say it's well over 50% of new clients that will still say to me today, yeah, thanks very much, but we're still going to go mainstream. And it's only as they come on board with us and after a few years that they start to go, actually, yeah, we get what you're saying. Let's have a little look at the testicles. So we offer them the choices, and they take them.
Interesting, 50% number. Andrew, over at What Money, how's your client interaction experience work?
Yeah, this is the best bit, talking to clients. We know we run a charity. They know we're giving sort of people. And I love just talking to clients about how they can invest. Because a lot of people, let's face it, people recycle, they might have a hybrid electric car, they really worry about the ICE caps, etc. But kind of a lot of people don't realise what you can do with your money. So I love that interaction with clients, advising them and educating them as to what they can do. And I've had people walk out these offices smiling because their money can make an actual difference. So that client engagement, that education piece, flipping the narrative, just saying to clients of all ages that how they can make a difference through their money in addition to their personal behavior. So that education piece, I love it.
I wonder how much the COVID environment and David Attenborough have added to that narrative as well.
Absolutely.
James, your Tribe Impact Capital, potentially the clues in the name. I mean, your clients must come to you with some sort of expectation or not?
Yep, absolutely they do. And we're not for everyone. And that's okay, actually, because we're all on a journey and some of us are on a different point in the journey. So that's absolutely fine. But I want to pick up what Andy talked about, because actually, I don't know of any sector anywhere in the world where having clients who are bored or unengaged or not interested leads to better client outcomes. If your clients are interested in their portfolios, they will get better outcomes. And we work with this team of behavioral economists who basically prove this, because if you're happy with your portfolio, you're more comfortable with the volatility in the market, therefore you're less likely to panic when you buy and sell. And so, as Andy says, what we need to be doing is, rather than listening to the investment houses who are telling us how Trump election, Brexit, COVID is affecting our investments, what about we flip the question? How are our investments affecting the world? Because when you do that, when you get engaged about, oh, this is interesting, I hold a renewable energy stock, or I hold a battery storage stock, or I hold a whatever it might be, we get better client outcomes. And ultimately, that's what everyone is on the call for, right? How do we get better client outcomes? How do we strengthen that relationship? And for us, at least, and you'd expect me to say this, but I think talking about sustainability, getting involved in impact, ESG, whatever you want to call it, leads to better client outcomes.
Well said.
Right, we're going to go to another poll now. What proportion of the investments you advise on would you expect to be in a responsible, sustainable style investment? What proportion of investments you advise on would you expect to be in a responsible or sustainable style of investment? The answers are more than 10%, more than 20%, more than 40%, or more than 60%. So if you can have a think about that, please, and I'll get round to the results in a little bit. Can I ask each of you a little bit about, we were talking about fund providers earlier very briefly, but I'd like to break this into two parts if I could. Are there areas of investments that you feel are underserved by product choice and potentially platform availability? So that's the product availability side of things. But also, what resources do you find helpful in learning about responsible investing and percolating that into your proposition? So do you find the fund manager output helpful? And do you find other areas from the industry helpful? So a two-pronged question. If I could get you to start on that one, please, Dan. And Darren, before you answer, can I just remind listeners that they can table questions to ask later as well. We'll get around to a few advisor questions or audience questions a bit later, so you can type the questions in. But Darren, if I could get you to have a think about the resources, please.
Yes, quite a question there, Jake. So to summarize that, yeah, certainly at platform level, the platforms are becoming far more open. We've had to sort of, lobby them a little bit to get some of the lesser known ethical OICs and so on, on their platforms. I think resource-wise, I've mentioned Gavin at Worthstone. The other place that I find incredibly useful is Julia Drablow's Fund Eco Market. Yeah. That lady's a legend. And what I found is I've been able to build them into my process at an early stage, because my biggest nightmare, in honesty, and I think this is coming for all of us, is where clients start to peel back the portfolios and the funds that we're putting in front of them. And they're, I don't want them saying to me, hang on a minute, there's oil in here, there's tobacco in here, or whatever. And so having a robust process where you have clearly gone to someone who has taken the time and you can measure that up is so, so important. So those resources are critical, in my opinion, before we do anything, before we even come to, the actual fund analysis experts.
And the fund management offerings, Darren?
Yeah. So I'm sorry, there's an awful lot of greenwashing still, if I'm honest. I am at the more kind of deep dive side. So So I will find, I don't judge, because I think we've all got to do things differently. I think as long as you're straight with your clients and you tell them, look, this isn't going to eradicate everything, that's fine. But if you really want to kind of set the benchmark a bit higher, you probably need to go somewhere like Edentree, maybe Lion Trust, maybe Rathbone. Have a look at these guys. I talked to someone at Neville White at Edentree. You look at the screening, what they're doing there, they're doing it properly, in my view. I'm not knocking the others. We still gladly use them, but there's a big difference.
You'll be getting a call from 12 sponsors fairly shortly, Darren. Andrew, so it's the platforms, the resources that input your proposition, and the fund platform, the fund availability.
Well, I'd certainly echo what was said there. Julia Dubrow, I've met Julia, and her work with Fund Eco Market is fantastic and ongoing. We're a Old Mutual. Our preferred platform is Old Mutual. All the fund groups are on there. I've met with Lion Trust in terms of their process. I think one key thing to mention here, there's a lot of big players in the market now, so they're all throwing their vast resources at talking to advisors about what is available. The rating agencies, obviously Square Mile, there's a lot out there. I think we just need to be mindful of staying loyal to your process, because at the end of the day, a bit like years ago when we did mainstream, where we used to just pick individual funds because they were the usual suspects. Now, in your CIP, you've got to be very specific about why you choose a fund group, why you choose a fund itself, but that just be true to your process. But I think LinkedIn, Veronique Chaplot, Edentree, there's lots of great managers out there. And I think the only negative is there's too much choice. It's like you're in a sweet shop where you want all of them. So there's a lot of good players out there, but just be true to your process and review. We review annually. And I think LinkedIn, you could spend all day on LinkedIn. There's a lot of good stuff out there. So just engage with the managers and stay true to your process, because there's a lot of good stuff out there. And other advisors, of course.
James, before I get you to answer, I'll just quickly outline the poll results there. So more than 10%, there was 13% of you responded there, more than 20%, that's 36% of you, and more than 40%, which seems to be the sweet spot, actually around 40%. More than 60%, 14%. So they're the proportion of the investments you advise on would expect to be in a sustainable style of investment. James, if I could just pick up with you again, please.
Yeah, so we're talking about, the kind of bits that are missing, I think, and as both Andy and Darren said, that we're in a sense we're spoiled for choice, especially in global equity. That there are less options, I think, in some of the regional specific. There's some Asia Pac funds we like, not very much in America, which is both odd and understandable. I think that I'd also pick up on the question or the issue that Darren raised around kind of greenwashing or whitewashing or whatever washing we're going to be calling it, because I think that there is this huge pressure now on every asset manager to have a sustainable offering. We talked about it, I think, in the opening creds here, where the amount of the flow into ESG funds in I think between April and August, the 4 months, was bigger than it had been the previous 5 years. So clearly there are a lot of people jumping on a bandwagon. And so now, whilst that's good news because more people are generally thinking it's important, it's harder news because it means you have to scrutinize everything. And we can talk about ways of doing that. Obviously, we spend a lot of resource at Tribe doing it, but not others on this call will have that. But one of the things, funds will always blow up. There'll always be an embarrassing holding. Hopefully, you don't hold them, but when you do, if someone holds Boohoo, it was interesting to see first of all who held it, and then secondly those who sold it in their ethical or ESG fund but didn't sell it elsewhere. And that for me is quite interesting, because somewhere in that institution they're going, oh, this is an awful company. We can't hold it for ethical reasons, but we'll still hold it in the rest of our portfolios and the rest of our funds. And that, I think, in terms of a quick way of getting the sense of how important is ESG to this institution, is a good way for advisors to get the looks from that.
And is platform availability an issue for you? And what sort of resources are you generally looking at in the market to help improve your proposition?
So we spend quite a lot of time in the market, actually in public policy level. What's interesting for us is to see where public policy is heading. It's not just the regulator, but also Bank of England or whoever it might be. And so we spend a lot of time in the market. There's some good data out there. No data is perfect. Everyone will have heard of ESG from Sustainalytics or from MSCI. They don't agree on any of the ES and G metrics, which actually I think is probably quite a good thing. And in terms of platform availability, yeah, we could all do with a bit more speed in terms of turnaround on platforms. But generally, I think because it's such a competitive marketplace in the platforms, they're pretty good at it.
That touches on an interesting subject. The question's just come in, James, on would you like to see some more help from the regulator on this subject? I don't know if any of you have some views on that, but James, sounds like you might.
No, actually, bizarrely, we came through the FCA's Innovation Hub when we set this up, and the regulator is all for this. And the reason they are is because in order to be presenting this to our clients, we have to understand our clients a bit better than normally. We have to understand the portfolios we're recommending a bit better than we might normally. And we have to explain what's going on in those portfolios a bit better than we might have normally. So the regulator is absolutely here. And people will disagree, but I think they're basically saying, it's an open door, of course you can do it. And then the industry tends to go, well, tell us exactly what we should say. And the regulator goes, well, I'd never tell you exactly what you should say. Here are the principles that we should apply with. I think the regulator has done, others will disagree. I think the regulator has done a pretty good job of saying the door is open for this.
Darren, Andrew, do you have any views on that?
Yeah, I think they have done a great job so far, and they've definitely created awareness. The problem we have is that, I think we could be seeing actually the next big sort of green mis-selling scandal coming our way. I think that there are so many funds out there that are masquerading as ESG, yet when you look at it, you look underneath it, I don't think it's what the client really thinks they're getting. And I think that's going to be a major issue. So whether that's an investment association issue in terms of grading funds and saying, right, this is a kind of a, this is an ESG fund. It's well governed. You've got oil companies that are behaving responsibly, tobacco companies that are behaving well in terms of how they treat their staff and all of that. This is properly responsible, sustainable, ethical, whatever you want to call it. And I think there's this real danger that the public are just going to slip through the cracks here and end up with things that they think are doing something that they're not. And I think this is a great opportunity for us as IFAs to really, really demonstrate value to our clients and educate them, as Andy's been saying, on what is in these funds.
Anything else to add, Andrew?
Well, my colleagues there just are spot on. I mean, the education piece has got to be relentless. It's got to be ongoing. The regulator absolutely wants us to follow through with this. And let's take it from an ethical point of view. Why wouldn't we want to enhance the whole ESG story? I think one point I'd like to make is acronym overload. So I don't know how we're going to create a sort of, I talk to people, I talk to my friends and ask them what ESG stands for, and no one gets it. But I think all of us, we've got so many ways of skinning this cat. So maybe the IA or somebody's going to come out with a more consistent message, because as Darren said, there is greenwashing going on. So as advisors, we've got to be careful to have the right process, to trust in the appropriate funds, to do the right thing for our clients.
I think everyone will agree with that. Another quick question. We've had a question. Is it easier to add a percentage of ESG SRI funds in the form of multi-asset fund solution rather than using them in isolation? Just a quick response from each of you on that. Darren? Yeah,
brilliant diversifier. It's a great way of dipping your toe in the market. If you're not used to, purely sort of responsible funds and you've always been a bit wary, brilliant way of putting them into your portfolios. First of all, watch how they go, learn about those funds, and then that should give you the confidence to build your first ever ethical portfolio.
Andrew?
I concur with that. Nothing else to add, really. It's yeah, say no more.
James, you manage portfolios, I guess, so.
Yeah, and we'd agree. Whilst we think this is the best and only way to do it, it is a journey. And so we'll often sit as a kind of a starter where we might be at 5% of an allocation, and then we will move up. And the point is, our business, like everyone else's business, is not here to make a quick buck. We're here for the journey. We're going to be here in 5 years' time when the clients are more comfortable with it, and we're happy to be on that journey with clients and with advisors to say, let's go on this together. We've got to be a bit more tolerant of people taking their time to get to grips with this.
My next question, again, a two-pronged one. There's obviously a lot of asset managers sponsoring this event. There's a lot of fund managers tuned in today listening. What would you say to them, and also generally about the industry? What would you like to see coming from the industry that's with respect to messaging on responsible and sustainable investing? Darren.
Yeah, I've probably been a bit harsh, haven't I, on the fund groups today. I love you guys, you're wonderful, and please keep doing what you're doing. But yeah, just be a bit stricter would be good. As far as, you know, what the CII and MSCI, the CISI, etc., I challenge you to build us a proper impact, ethical qualification. At the moment, we've got Weirstone with their ACT qualification. There's not a lot else out there. It would be brilliant if we had a kind of a benchmark, because I think for a lot of IFAs, if they went through that, they would come out a lot more confident and feeling, yeah, okay, we've got some competence here, we know what we're doing, this feels like the right way forward. So that's my challenge.
Very interesting. I know the CFA's got a ESG certificate that is quite popular now, but something's a little bit more planning focused could be interesting. Andrew, any views on that? Fund managers listening and the industry more generally?
Yeah, an ESG academy, wouldn't that be a great thing? I think they're all on the journey at different points. I know BlackRock came in last year to bring ESG. I think one thing we've got to be really careful of is when fund managers, when fund groups bring out separate ESG funds and don't integrate ESG into their mainstream funds. That's a challenge for the marketplace as a whole. We all know I read recently there's $1 trillion that's now going into sustainable funds for the first time in history. But let's look at, I read last year, I hope it's not true, but trustees on US corporate pensions, there's no ESG option. So you think about how many noughts are on those numbers. So I think, just to echo what Darren said, there's got to be an education piece for advisors, not just that are coming into the market with fresh ideas, but us older ones, we're on an education journey as well. So there just needs to be some uniformity and a way of educating all of us so that our outcome for our client is a more positive one.
So it sounds to me like the ESG Clarity needs to get together with the Chartered Institute of Securities and come up with an ESG Academy. So Natalie Kenway, over to you on that one. James, any comments there?
No, I think others have made the points really well. I think probably one of the things that we've talked about in this conversation a lot, journey, and including that is humility. And sometimes there are certainly some institutions who I don't feel come across as having a degree of humility, saying that actually, you know, we got it wrong historically, but this is how we're getting it better. And I think that if you're a salesperson from a fund institution, you tend to go and thinking, I've got to sell this because it's got to be the best thing that anyone else has got, and it puts the wrong message out there. I think those fund managers need to be recognised that everyone in this ecosystem is on a journey, and if they don't start using that language as well, we're going to, as Darren said, get into an awful lot of trouble later on.
One very short question, technical question, perhaps James, you might be best placed to answer that one. Is there a size restriction on assets under management when considering investing in an USG type fund?
Not for us, no, because often the size is a kind of question of like track record. How, you know, what is this thing going to do? Which you've got no idea unless you're actually spending a lot of time thinking not only about the investment process but about the impact process. If you've understood both of those processes, you're much more comfortable than if you're only looking at the investment process for a fund. So if you've done twice the due diligence, you're more comfortable taking earlier stage investment opportunities, which for us has done particularly well over the past few years before the mainstream capital starts to come in.
Excellent. We're almost out of time, but I'd like to ask each of you in conclusion to basically advise your fellow practitioners. What advice would you give to advisors that are perhaps not as far down the pathway as you are, or thinking about getting onto the yellow brick road of sustainable investing? In conclusion, about a minute each, no more than that, please, if I can get you to conclude there, Darren.
Yeah, no problem. I think the first thing I say is work with what you've got. Don't reinvent the wheel. Don't try and promise something you can't really deliver. It's better off to offer something that's maybe just a toe in the water. Maybe it's just, you know, one portfolio if you are going to run that portfolio, run it behind the scenes for a year. Don't jump into this too quickly. Get it right first, and then I think you're going to be a lot safer further down the line.
Andrew?
Yeah, great question. It's education. I keep banging on about that word. If you're just coming in the industry or you've changed careers and you're looking to advise clients, the FCA, we need to do it. From a conscience perspective, we should be doing it. And I just think you just need to look at the resources out there because they're wonderful. Speak to other advisors, the gentleman on the panel today, fantastic wealth of knowledge there. Just engage with those around you because it's a massive opportunity to educate, especially in lockdown times when people they're not leaving their homes to go to an office on a train in a car, so there's less carbon. So this is an opportune time to talk to people about making more of a difference. So just get out there and look at LinkedIn and follow people that are already doing it, but education, education, education.
Thank you. James, final word to you, advice to fellow practitioners.
It's hard to put more on what both Darren and Andy have said, but I think hopefully one of the things that comes across is that once you're in this, you're quite passionate about it, and actually so talk to people like those of us on the panel who've been on this journey who may be a bit further ahead or maybe even further behind you on the journey here. And actually, broadly, we have a model portfolio service. I actually don't mind if you speak to us and use somebody else, because ultimately we believe this is a rising tide. And I don't win because someone else loses. I win because we all start talking about this. And I think that's an attitude that I found throughout this sector, that there's less of a sense of this is my client, this is my asset. We're here because we fundamentally believe this is the way that we need to manage clients and we need to manage investments. So give any one of us a call and we'll definitely tell you about all the mistakes we've made as well as the things that we've learned along the way.
It's been fantastic talking to all three of you today. I've thoroughly enjoyed it, and thank you very much for your time. We're finishing pretty much on time for the session, so that's great. I've been speaking with Darren Lloyd-Thomas, Managing Director at Thomas & Thomas Ethical Investments, Andrew Watt, Director at Watt Money, and James Lawson, who's a partner and co-founder of Tribe Impact Capital. We are now going to go over to the Ask the Experts recorded videos. So you have the opportunity to ask the experts and we'll get back to you. Feel free to email over any questions you have for another Ask the Experts session, but straight over to Ask the Experts. Thank you.
Hi, my name's Lawrence Gosling and I'm the Editor-in-Chief of Watt Investment. And I've got a simple question, I think. Has the pandemic created more opportunities for responsible investing?
Well, that's a great question. If we look back to the start of the year, the topic of sustainability was already at the top of the political agenda, with new climate initiatives ranging from the organization of the COP26, the United Nations Climate Conference, to the launch of the Green Deal in Europe. In the financial industry, regardless of the pandemic, sustainability has remained on its trajectory into the mainstream, with asset managers, including ourselves, focusing on the integration of environmental, social, and governance factors into existing investment solution. At the same time, we have continued to see the development of new sustainable investment solutions accelerate in response to growing investor demand. This can be evidenced by strong market flows into sustainable funds across Europe. For investors, we believe the crisis will ultimately accelerate the ESG agenda. Environment is, of course, only one aspect of the equation. The crisis also highlights the importance of social and governance factors as companies focusing on all stakeholders instead of just shareholders have proven to be more resilient so far. At JP Morgan Asset Management, ESG factors are a critical part in how our investors build and manage our clients' portfolio. Today, we are now ESG integrated across 450 actively managed investment strategies, representing $2 trillion of assets under management. We also believe that climate change should sit at the heart of investment management, and we are committed to helping clients navigate the challenges and opportunities arising from transitioning to a low carbon world. In addition, as a firm, we recently announced that we will be adopting a financing strategy aligned on the Paris Climate Agreement, which aims to contain global warming to 1.5 degrees Celsius by 2050. In conclusion, The current pandemic highlights that environmental, social, and governance factors can have significant implications for the economy and society. In this context, we believe that embracing ESG is not a vague, distant goal, but something that immediately strengthens the resilience of our societies, our companies, and ultimately of our investment portfolio. To better understand this dynamic, we have developed a range of new tools and material within our Market Insight program to help you navigate this topic with your client.
If responsible investing is not a short-term phenomenon, have you seen an increase in funds flow since the start of the pandemic and performance returns that could continue to attract new monies?
There's a good chance that we'll look back at 2020 as a turning point. COVID has both underlined the need to tackle social and environmental pressures that have been building for many years, but it's also galvanised political action. As we come out of the crisis, it will perhaps show a very successful test to the value of sustainable investments. Today, social and environmental change is happening faster than ever. People are increasingly conscious about the choices they make, from where they shop, the food they eat, how they travel. Every year, we undertake a survey of global investors to learn more about their attitudes to sustainable investing. In our latest global investor study, respondents told us that their values increasingly drive their investment decisions. It's therefore simply a matter of time before we start to see these preferences really driving flows into sustainable investments. And in fact, that's actually what the industry and Schroders has seen since the onset of the crisis. Based on Morningstar's data on ESG fund flows, we're on for another record year. At the midpoint of the year, over 110 billion pounds of new money had been invested in European ESG funds. And for two of our own sustainable investment funds, new flows have taken them close to the $1 billion mark. The market volatility we've experienced has also provided an opportunity to test this thesis. And we've found that all of our sustainable funds have outperformed over this period. We've done some particular analysis looking at European equities. Our proprietary tool Context ranks companies according to their sustainability characteristics. And using these rankings, we've looked at how have our highest rated companies performed relative to the average. And we're pleased to say that they've done better. Now, interestingly, when we look at the laggards, so those that we rate most low, actually they've performed worse than the market as a whole. And as I mentioned, we've looked at the performance of our sustainable funds over this period, and they've all outperformed their sustainable peers. So it appears that the performance of funds have held up. Fund flows continue to be very strong, both clear indicators that responsible and sustainable investing is here to stay.
Gavin Haynes, investment consultant at Fairview Investing. My question is, how should fund buyers assess whether asset managers are adding value from an ESG perspective and avoid those that are greenwashing their propositions?
Now, that is such a wonderful question. Greenwashing is typically defined as companies making misleading claims about the environmental benefits of a company or a product. And in the asset management context, it tends to refer to managers who pretend to take the environment seriously, but don't really. Now, how do you know if managers really are taking the environment seriously, if they're really green? I look at 4 criteria. The first concerns exclusions. If you go back 10 years, quite a lot of companies said that they could construct a sustainable strategy by cutting out the worst X% of companies from an industry and then investing in the rest. This may have been satisfactory a decade ago, but these days it just doesn't fly. For instance, within the fossil fuel industry, I'm sorry, fossil fuels or fossil fuels and green managers should not be investing there. For example, the Wall Street Journal recently found that 8 out of 10 of the biggest 10 ESG sustainable funds in the US were invested in oil companies. They claim to hold the least bad oil companies, but that's not good enough. Just doesn't fly these days. Secondly, if managers take the environment seriously, I think that they have to genuinely align themselves with the Paris goals. Quick reminder, the Paris Agreement of 2015 was designed to limit global greenhouse gases from 2020 onwards, to try to lower global warming to below 2 degrees in the long run, preferably only 1.5 degrees. That means that the world should decarbonize, net zero emissions by the year 2050. Now, if you're an asset manager, you want to present yourself as green, then you simply have to sign up to these. I don't think that there's a choice about that. For asset managers, this means that they must be trying to make their portfolios 100% sustainable by the year 2050. They should be targeting zero net emissions by 2050 at the latest, and preferably earlier than that. And they should be publishing reliable and publicly verifiable numbers on this. And it entails various things. Yes, they should be reducing the carbon intensity of their portfolios. They should be cutting out the worst firms. They should be cutting out on bad sectors, like those which have high indirect emissions like utilities and, for that matter, meat production. And I'd expect to see green managers investing in firms and products that are designed to make the world greener, like renewable energy. And they should be trying to make a positive impact on the world. Third, I'd expect to see green asset managers lowering their own carbon footprint. And as businesses, they should have zero carbon or even negative carbon targets, preferably by 2030 at the latest. Okay, they won't change the world this way, but they should be practicing what they preach. And finally, green asset managers will try to influence companies in green directions. You expect them to vote actively at shareholders' meetings and to sponsor and support green initiatives. Now, I saw research from Morningstar which said that a big Vanguard US ESG fund last year supported only 3 out of 84 of the most popular ESG resolutions. Sorry, that's simply not good enough. Sometimes, of course, these managers claim that they influence companies behind the scenes, somehow, rather than upfront. And I think that's nice, but that's also not good enough. And so, in short, I think if managers are delivering on these 4 criteria or are trying hard to improve on them, then I think they can be regarded as genuinely green. Otherwise, I think you have every reason to suspect that there may be greenwashing. Thank you.
Thank you. Now, given the importance of platforms to the advisor market, how are they going to cope with this new raft of information that's going to be available? Over the next 3 events, we have representatives from the three of the leading platforms in the UK market: Standard Life, Funds Network, and Aviva. And their representatives will give you some insights into how they feel they're going to address this challenge, providing you with access to the information that's going to be produced by the manufacturers, the asset managers, on the funds they're offering. Today, I'm delighted to say we have Jenny Davidson, Head of Platform Investment Solutions at Standard Life, who will provide a perspective on how Standard Life will cope with this new challenge going forward. Jenny, over to you.
Hello, my name is Jenny Davison and I head up the Platform Investment Technology team in Standard Life. So my remit covers the Elevate and Wrap platforms. I've been asked by Square Mile to talk about ESG and platforms, and my first thought was, where do I actually start? We know demand for sustainable investment solutions in all things ESG, that's environmental, social and governance, is rising. ESG investment has actually boomed in popularity over recent years, as fears over climate change has led to consumers and investors considering actually the impact of their money. Individuals are increasingly investing according to their values, and this has been turbocharged due to the COVID crisis. A recent article in the FT Advisor highlighted that ESG investing is estimated to be more than 23 trillion in assets under management, or as it's stated, a quarter of all professionally managed assets around the world. Interestingly, and not surprising, the British Great Sustainability Savers Survey 2020, carried out with Borrowing Money, stated that investors' family future is a key driver for sustainability investing. But before I go any further, let's recap on what ESG is, because to me it's quite confusing. So at a high level, responsible investing is when investors consider environmental, social and governance. So that's the ESG factors in what they choose to invest in, as well as how they look after the investments. So ESG issues can be used in one or more or a combination. Firstly, there's ESG integration, when managers consider the risks and the opportunities of each investment based on how the company manages its ESG practices. Then you have screening and thematic approaches. So looking at ethical funds, effectively it's whether you screen in or out certain investments based on ESG criteria. Looking at thematic approach such as impact investing, that involves investing in companies that really target specific environmental or social outcome. And then finally, stewardship, which is really interesting, is the other key approach to investing responsibly. That's where investment managers actively engage with company management and use voting rights to really influence their conduct on ESG issues. But looking at platforms, I know some platforms are already including questions around ESG when they undertake due diligence on fund groups and looking at the underlying funds before adding them to the platform. I think this is going to become a growing focus within due diligence that is undertaken by the platforms and advisors. For advisors, this will be crucial probably to their centralised investment proposition. But if you now look at global regulation, they've been paying more and more attention to the role of ESG factors and the inherent risk and performance. They also recognise the importance of directing capital into sustainable investments that can support resilient economic growth and help rebuild an economic future, especially important in a post-COVID world. So there's a surge of client interest, we've talked about that. There is a need for greater scrutiny and improved transparency to protect consumers. And that then leads me on to the proposed ESG amendments in MiFID, the UCITS Directive and the Alternatives Investment Fund Management Directive and undertakings. So these are new regulations, new proposals that will actually mean it will be mandatory for advisors to ask clients about their ESG preferences as part of the advice process. They're going to have to identify their sustainability preferences and then recommend the products and the services that are suitable on that basis. It will mean that advisors will be required to explain to their clients in suitability reports how their specific preferences have been incorporated into the recommendation. And importantly, it does make it clear within the proposals that preferences should only be addressed within the suitability process once the client's investment objectives have been set, the risk level and the time horizons have been identified. So there is an expectation in the new rules, once they're implemented, that the advice processes will need to evolve. But also as part of the new amendments is a focus on improving disclosure by investment managers on sustainability risk. This includes disclosing potential volatility in the value of the investment due to the ESG factors. So for me, working in the platform industry, and for all platforms, I'm sure we're reviewing these regulations and really looking at ways in which we can actually support advisors and their clients with these. So as I've mentioned, there are different approaches to ESG. And of course, ethical and social issues are highly personal and will vary for each client, as this regulation acknowledges. But it's the additional facet of individualisation that is really the biggest challenge, I think, for advisors. It's how do you choose the right type of ethical investment for each individual client? And what that will mean is understanding the various options that are available out there in terms of the ethical fund choice and how each of them works and well enough to actually fit to that individual client. What's interesting to note, and I'm not going to go into it, is about the Boohoo saga, but highlight the ESG minefield faced by advisors and emphasises the uncertainties inherent in ESG investing. But I do believe that investment firms do have a responsibility to provide education material and to really have a focus on standardisation of disclosure for these types of investment products with these ESG related features, so that advisors and importantly investors can actually comprehensively really evaluate whether or not the investment products will actually meet their needs. I note the CFA Institute has actually just published a consultation paper just on this very point. So looking at platforms again, we accommodate a breadth of funds and model portfolios run by discretionary managers that really do meet the demand from clients who want to invest responsibly. But platforms can do more. And as investment firms innovate and launch new products, I believe that platforms will have a significant role. Essentially, in this digital age, the combination of technology and data is making it actually easier to respond to everyday life according to an individual needs. We can all now access hundreds of thousands of songs simply by using our smartphones to play us the perfect playlist. Television streaming services can now provide a unique, tailored experience of a viewing habit. And every time we visit a website, there's a good chance that the ads we see are relevant to us and specific to us. So the services are all tailored to our needs, and the same thing is happening with investments. And to many clients, this extends to their preferences for how ESG is applied to their investments, and why not? Centralised investment propositions have really helped create efficiencies and the consistent treatment of clients. And since MiFID II and PROD, there's an increased scrutiny on suitability and a focus on solutions that really do meet clients' needs. But providing a standardised, personalised investment solution can be challenging. We all acknowledge it can be expensive. It can be manual in terms of processes if they're not supported by technology and a platform technology. The manual work and extra time it takes to manage these investments can also increase the risk to investment managers and the advisors they work with. As more clients demand personalised investments and tax optimised outcomes, platform technology needs to digitise the investment processes. Platforms need to be able to offer personalisation, individual portfolios that are really tailored to a client's specific needs, whether that's the specifics of capital gains and tax management, or actually looking at ethical convictions, thematic beliefs. Ideally, this should be delivered through automation. We've just delivered this on our wrap platform through what we term individually managed accounts. And IMA is about delivering individual outcomes within a centralised investment proposition. It's a model portfolio-based technology solution that really enables personalisation to be reflected so that clients' needs, preferences or restrictions can be reflected within it, creating that personalised solution. So one thing to say from me finally is that for ESG, it's about recognising that what we invest in today will change the world we live in tomorrow, and platforms have a critical role in that, supporting you as the advisor. Thanks for listening.
Thank you very much, Jenny. We're now going to move on to the asset manager panel. And again, the topic we're going to discuss is how COVID-19 has accelerated the adoption of ESG investing. My name is Richard Romerly. I'm Managing Director of Square Mile, and it's my job to moderate this forthcoming session. I would please ask you to ask questions through the Slido app, and we will submit as many of those to the panelists as we can throughout the session. Thank you very much. So I'm delighted to introduce today Charlotte Nesbitt, who is Analyst, Governance and Responsible Investment at Janus Henderson, Catherine DeConnick Lopez, who's Global Head of ESG at Invesco, and Ewan Sterling, Global Head of Stewardship and ESG Investment at Aberdeen Standard Investments. Now, I realise some of those titles are a bit of a mouthful, so I'm going to ask each of the panellists to spend 20 to 30 seconds describing their roles so we have the context from which they're going to be talking to us. So Charlotte, please can I ask you to go first?
Sure. Hello, everyone. Yes, I'm Charlotte Nesbitt. I'm a analyst on the governance and responsible investment team here at Janus Henderson. We are an internal sort of ESG resource for our investment teams across the group, and our sort of main priorities are focusing on company engagement, voting, and working with all the investment teams to integrate ESG into their process.
Thank you. Catherine.
Thank you. Yes, I'm Catherine DeConick Lopez. I'm the Global Head of ESG for Invesco. I've spent more than a decade in ESG investing, and I lead a global team of ESG experts at Invesco, focusing on client solutions, products, research engagement, proxy voting, as well as data and analytics.
Thanks, Ewan.
Yeah, good morning. Ewan Sterling. Apologies for my job title, but what I do is I lead a team of the ESG experts at Aberdeen Standard Investments. I've actually spent most of my adult life in investments, largely as an equities analyst and portfolio manager. But in 2016, I saw the light and transitioned to an ESG role. And that is designed to ensure that we can say with a high degree of confidence that ESG factors are considered in every investment decision that we make. And that's because we believe it's a critical ingredient in generating the right outcomes for our clients, which is better risk-adjusted long-term returns.
Okay, thank you very much for providing that context. Let's get straight into the meat of the subject. So how COVID-19 has accelerated the adoption of ESG investing. Charlotte, I'll start with you. What are the biggest impacts that you've seen this wretched pandemic have on ESG investing?
So I think it's been a really interesting period for ESG, and we've seen, you know, a sort of, I think the key word would be acceleration of a lot of trends that were in the process of coming to the forefront of companies, shareholders, stakeholders' minds, but really the pandemic has brought these into a really sort of, into a huge spotlight. So there's been a lot more focus in the sort of transition towards stakeholder capitalism, and there's been a huge amount of broker research and wider sort of financial press commentary that's really sort of brought to light and focused all of our minds on various ESG issues. And just to name a few that I've, you know, seen and had various conversations with analysts, portfolio managers, and companies would be sort of human capital issues, supply chains, employee well-being and mental health, and just general sort of governance, business structures, which are sort of being resilient in the face of this change that the pandemic's brought.
So it's had a direct impact on the way companies are behaving, you think, and the way we're all behaving.
I think it's interesting. I think a lot of companies were already realizing how important ESG and sustainability factors were to investors. And this has really sort of shone a light on it, where they've all been put in really challenging positions just in their business operations and looking after their employees as well. You know, every business has had to do that. So I think along with the sort of, you know, questions on how they're managing their balance sheets and the actual sort of, if the financial stability of the companies, a lot of the questions from, you know, our analysts and PMs to these companies who they've known these management teams for a very long time, has been around how, you know, resilient they've been. And I think what's been very clear during this pandemic is sort of brought quality management teams really into the spotlight, and those companies have fared pretty well through this.
Okay, so it sounds to me like some chickens are coming home to roost, if that's the right expression. Catherine, moving on to you now. What else do you see as the main impacts that this wretched situation has had?
So I think there has been several impacts, but I would say sort of the buckets are around engagement with companies, the social issues, but then also the sort of product solutions and the wider spotlight on ESG as an industry and a concept, you know, individuals wanting to express their values in their investment solutions. And so, you know, in terms of the first point around engagement, what we've done is done a public letter, and you saw over $9 trillion of the industry signing this public letter to effectively it's a public statement, but to the industry and to companies saying, and it's run by the Interfaith Center of Corporate Responsibility, and effectively it said, as investors, we care about the social aspects, we care about community rights, we care about employee rights, and we care about your corporate governance and kind of financial prudence during this time. And so I think that's been pretty powerful. It's kind of a public statement from the investment industry. I think to Charlotte's point on research and bringing the social side to the fore, certainly what we've done, and I think many others, we have seen an increased focus on that social element, and particularly an area of interest for our research has been around the community aspects, and corporates becoming more kind of the public private partnership during this time has just been incredibly unprecedented, because clearly companies can't operate if their community is not functioning, and so it's put sort of an emphasis on that issue of community relations that just hadn't previously, I think, been seen to be such a material issue, but clearly is today. And then I'd say on the products and solutions side, look, we've seen an increased interest in, what can my investment solutions do? How can we be thinking about these types of issues as part of my investment solutions? And I'm sure we'll come on to performance, but sure, definitely the kind of positive performance aspects you have seen during this time from, companies that have been addressing these issues relatively better has been very positive for that trend that, was going on for some time, but I think accelerated that trend.
Okay, and that's fascinating. So a couple of things there. So are the companies coming to you for support and help? And what if they don't respond?
So I think, yes, companies are absolutely coming to us for guidance and help, and have been, I would say definitely as an ESG team, we are constantly thinking about advising companies and engaging with companies. And that is our approach. We have a very collaborative approach to engagement and looking very much at improvements over time. So I would say definitely constantly companies have come to us for help, but now specifically on this issue. So I would, that's been sort of a big trend for several years, but now specifically around, the social elements. From our perspective, we do also then proactively ask, even there are certain companies that don't come to us, and we would proactively ask. And I would say, actually, in my experience, companies have been incredibly responsive. And it's been a lot around kind of transparency, and I think companies recognize that this has been unprecedented for the entire world, including the companies themselves and their managements and their boards. And so many of the companies are on a journey around, the social aspects and how the boards address the social aspect. And so, we've had a lot of conversations around that, particularly the governance of the social aspects of ESG.
Okay, but if they don't respond, will you not invest with them?
No, we don't have a non-investment policy in terms of not responding. We would continue to encourage a response, but we do, as an active, largely active, we have some passive business. We have extensive insight to management, and we haven't really experienced that companies don't respond to us.
Okay, that's encouraging. Ewan, sorry to keep you so long, but again, what are the main impact that you've experienced above what Charlotte and Catherine have already discussed?
Yeah, well, I was thinking about that in the context of our own investment teams, Richard. And for us, the integration of ESG is about amplifying the importance of environmental, social, and governance, all long-term factors in the investment decision-making. And I think what COVID has forced us to do, because it's caused, in many cases, generational change in the blink of an eye. So it's caused us to focus, I think, more as investors on those long-term factors. So I think that the the focus now on responsible investing across all of the funds that we run in all of the asset classes in all parts of the world is probably higher now than it's ever been. So if you think about some of the long-term trends that had been underway, the death of the high street, look at high streets now, look at how they've changed just as a result of COVID and all the restrictions. Look at the way that we use office buildings, or don't use office buildings at the moment. I think we're all sitting at home at the moment. So what does that mean for future demand for offices? Is it dead? We don't think so, actually. We think that there will continue to be strong demand for modern, flexible, wellness-focused office space. But it is going to change the way that everybody works, and that's going to change investment patterns. They have to respond to the way that demand patterns have changed. And you know, we're seeing what could have taken 20 or 25 years has happened in 6 months.
Okay, so fascinating stuff. There's a question coming from the audience here, but we'll explore performance in a minute. But really interesting question: do the panelists now believe that capital flows will drive change faster than political initiative? We may already be there. Catherine.
Well, I mean, I think you need both. I do think, you know, we have seen an increased uptake in the regulatory initiatives and the interest from UK, but also European regulators, and clearly in the advisor space, the sort of requirements to proactively ask the question around ESG preferences is coming. And, you know, clearly the advisors we heard earlier are being very proactive. But I would say that's maybe not the majority of the industry today. And so I think that will accelerate certainly the conversation. And I would imagine also asset flows, clearly the future will tell, but I would imagine that is a, you know, direct impact. Now, in terms of kind of direct capital flows and the materiality aspects, that's already happening. I mean, you saw over 70 billion going into European ESG products just in 2019. And, you know, that trend continuing into 2020 and several new products and solutions being built. So in Q1 and Q2, we had 100 new funds just in Europe. So 200 adding to so we're now at 2,700, you know, options in terms of ESG products on the across European investment basis. So that's, you know, pretty substantial. And I would say definitely, you know, the product plus the demand and the materiality in the market definitely is driving capital flows as well. But I don't think it's one or the other. I think they go hand in hand.
Okay, Charlotte, would you add anything to that? What about the sort of social drivers here as well?
Yeah, I think I'd agree with Catherine. I think there's a place for both as well. You know, we're seeing through the pandemic, a lot of governments wanting to build back better and sort of announcing green response recoveries. And I would say that sort of is mirrored as well in what we're seeing in terms of capital flows. As Catherine said, we've seen a huge amount of inflows into ESG strategies, particularly during the pandemic time. Sort of July, I think there was a record high of inflows going into ESG strategies, and climate still tends to be the most popular, and particularly in terms of ETFs, climate's the most popular. So I think there's a real place for both. And definitely with the social side of things, you know, I think it's been fascinating just watching this kind of real focus on, you know, a lot of pre-existing issues in society that have been brought up through COVID. And then it's, you know, companies you've seen responding as well as their sort of corporate statements to things in response to, you know, the death of George Floyd, Black Lives Matter, inequality, frontline workers. It's been a very interesting period to see. And I imagine there will be more capital flows driving that, but also responses from government, particularly as we sort of try to rebuild our economies after the pandemic.
Okay, perfect. Ewan, would you add anything to that?
Yeah, again, a slightly different perspective, I hope. And I think about it in the context of how our clients' capital flows into our organisation as an investment firm, and then how we apply that capital as active stewards of that. And what COVID has done is, I mentioned it, rapidly changed demand patterns, and we're watching the corporate response to that. Now, we have to ration the capital that our clients have entrusted us to invest. We cannot run portfolios with a huge amount of cash that can then meet this demand for recapitalization during a crisis period. So we have to ration that capital, and it brings an interesting point of leverage for us as investment managers, because we can insist on improved standards of environmental responsibility and management, social responsibility and management, and also insist on the best governance arrangements to make sure that these responsibilities are fulfilled. So it's to those companies that are dealing with the E, S, and G risks that we allocate that capital. And it's the crisis that has brought us to this point of leverage to be able to press home those issues with the companies that we're looking to generate the long-term returns.
Okay, so Catherine, you talked about performance earlier on. And ladies and gentlemen, please keep your questions coming in too. Talked about performance, and what we've seen, I think we've seen is good performance from sustainable businesses, in particularly, and that's been amplified in the pandemic. So 2 questions: has the myth that you have to give up performance to invest responsibly been completely busted? Right? And secondly, do you expect that to continue, or evaluations being stretched? So Catherine, I'm going to ask you that one first, please.
So I think it's all down to education and understanding what different products do, because I do think, there are different ESG, the ESG products sit across the spectrum. So kind of heavily exclusions focused to sustainability focused to impact. And I think across that spectrum, you will naturally see different performance profiles, different risk profiles. And so, I don't think that the myth, and so to speak, it's a lot more nuanced than just saying, ESG products always outperform or they always underperform. It's a lot more nuanced than that. I would say broad ESG funds have done, as well or better than non-ESG funds, and that's been a trend that we have seen for not just during the pandemic, actually for a little while longer than that, but still it's a short history, right? And if you think about quant teams and so on, they work in 10 years plus histories. So I would say, look, it's more nuanced, but certainly the indications are very positive. And in terms of a client's perspective and education around that, I think there's still a way to go, but certainly the evidence is very positive, and what we're increasingly seeing is that it's more and more understood that you do not have to give up financial performance for the the ESG product or outcomes that you are seeking.
Ewan.
Yeah, we concluded quite some time ago that the only way that we can achieve what our clients want, regardless of the mandate, which we believe is better risk-adjusted returns in the long term, the only way that we can achieve that is by taking account of the long-term factors in investment, which are E, S, and G factors. So I'm in absolutely no doubt that integrating ESG into your investment process is additive to returns. And it can help reduce risk as well. I mean, I mentioned in my opening remarks that I've been in the investment industry for many, many years now. And that has allowed me to witness some of the crises that can take place either at a macro level or an individual company level. And not only can that have direct financial consequences for individual companies when they get it wrong, but it can have long-term indirect implications in the trashing of reputations overnight. So companies that don't take material risks responsibly and don't deal with those issues are not worthy, I think, in many cases of our clients' capital, and we will not support them.
Okay, so and Charlotte, coming to you, obviously there are 2 sides to this. There's ESG integration. I think the points have been made very well about making sure that managers understand the influences and the risks associated with ESG factors in consideration of a company across any portfolio. Thinking more about portfolios with explicit responsible objectives, be they exclusion, responsible, sustainable, or impact. What's your view? Obviously, we've seen many of those funds perform really well. Is that sustainable, and will it continue?
Yeah, so I think, we have obviously seen, pre-pandemic and particularly during the pandemic, a lot of, research has been shown that sustainable and ESG focused funds tended to outperform, particularly during the sort of market crash and as we've seen companies try and build back. I think, the sustainability of, the performance trends of these types of funds is there to stay. As Ewan and Catherine said, the way, we look at it in terms of integrating ESG is that the analysts and portfolio managers are responsible for assessing what their own ESG, top priority risks are for their clients and their strategies, which at the end of the day, the reason they're looking at these types of risks and opportunities as well, but on the risk side is, in order to sustain long-term returns, and hopefully those are better risk-adjusted returns. The other side is that, looking at sustainability and ESG, which, hopefully tends to lead to better performance of companies, is that there's a huge amount of opportunity now for investments, in this sort of sustainability space. There's, as we've sort of talked about earlier, governments have been putting in regulation, which has meant, things like renewable energy has been a very popular area. There is, some parts of the market that have a slight premium because they've been the sort of ESG go-to stocks, but there's a lot of interesting opportunities coming up, which should be long-term investment opportunities.
Okay, so it's another question's come in from the audience linked to this. The person says, to stop climate change, the world needs to reduce consumption. A fall in consumption will negatively impact returns. So are 7% per annum returns a thing of the past? Ewan?
Well, reducing consumption is one way of addressing the climate crisis, and we do think it's a crisis. So of all the environmental, social and governance issues that we cover, it is worth calling out climate risk. We apply more resource and more time and more thought to that than any other ES&G risk. There is another way to address this, and it's through investment. So when we're presented with problems like this, and this is a particularly acute one, it presents problems, issues, and opportunities. And part of our job as investors is to focus on the opportunities and try and drive positive change. So some companies will have their business models challenged over the coming years. And if you think about the large fossil fuel companies, they're clearly in the line of sight there. But there are lots of opportunities that emerge in the form of clean and green power generation, for example, in electricity storage capability, in hydrogen-focused businesses that are producing fuel cells that can be part of the answer in the way that we as investors choose to tackle climate change. So I think there's a positive aspect to this that needs to be aired. You cannot ignore it because it's essential for our clients in the generation of those long-term returns that they seek.
Okay, Catherine, any comments you'd make on top of that?
Yeah, absolutely. I would say a big important trend in the industry is the Task Force for Climate Financial Related Disclosures, and I would completely agree with you, and that actually there's a lot that investors can do to be part of the solution to climate change, and it's as much an opportunity as a risk. And one area, so in terms of this TCFD that's it's called this way, really sheds a light on the governance, the risk management, and the scenarios. So by having better information around what your products are doing and your funds and kind of exposures, on climate risk, actually what we've found, and we've had a really interesting solution where we were running just a standard UK equities kind of quantitative systematic strategy. And we were asked, can you optimize it for 2 degrees, exactly the same risk return profile, no change to the actual, fundamentals of that strategy whatsoever. But we managed to do that with a 30% lower carbon footprint And it's now aligned to 2 degrees, whereas before the strategy was aligned to 4 degrees in terms of kind of trajectory. And so I think you are seeing more and more of those kind of solutions, opportunities coming out in the market. And I think, that's a massive opportunity for the individual investor to say, it's not just about consumption, it's actually about where I'm putting my money. And there are some stats showing that you can have 27 times higher impact through your investments in terms of reducing carbon footprints than you can have through, your recycling or driving an electric car as an individual. So I do think the power of financial solutions is an incredible opportunity for climate change.
Okay, so TFCD, for those just wondering, Task Force on Climate-Related Financial Disclosure. Okay, I want to move on a bit. In the advisor panel earlier, the advisors mentioned being worried about greenwashing, and they sort of leveled it at the asset management community, not you personally or your companies. It was more general there. So what I'm hearing from you, or from each of you, is actually the consideration of ESG factors is being fully integrated into your businesses. Okay, so can I seek confirmation of that from each of you? And then the second point is, what advice would you give to advisors to think about how they might spot whether someone is greenwashing or not? Charlotte.
Sure. So I think we look at it at 2 levels. At a corporate level, we are taking sort of ESG issues into account. So we've been carbon neutral for 12 years. We are doing a lot of work on diversity inclusion. And then at the investment level as well, which is the second way we look at it, is, it's not a top-down approach. All of our investment teams assess the ESG risks for their particular clients and strategies themselves. And so that way they're really able to tailor what to them and their clients is the most important risks and opportunities for them to be looking for. And a huge part of what myself and my other teammates work with the investment teams is through engagement. And that's really where, advice to advisors really would be, when they're sort of talking to managers, is actually sort of talking to them about what engagements they've had with companies. And those are really good sort of snippets to understand how a manager is integrating their process, whether they're, sort of being able to provide these examples of what are the key risks for them. And maybe it might be, we've had some teams which have identified themes of things that they want to engage on with companies, and then they'll sort of go and make a proactive engagement rather than just waiting for the companies to come to them. But yes, I think examples of engagements and how you're integrating that process is a good way of sort of speaking to managers about how they're actually integrating it.
Okay, so the evidence. Catherine, if I may ask the same question to you. Same question.
Sure, yeah. I mean, I think so from an Invesco standpoint, we definitely have a goal of full ESG integration. I would say for us, it's definitely a journey. 1.2 trillion is a huge amount of assets. And so we're seeing certain of our investment teams being further along in that journey and some being, earlier on in that journey. So I would say we definitely have a goal. We've got a public goal to have 100% ESG integration by 2023. And in our UK and European strategies, we will go a lot sooner than that. Now, in terms of how do you best speak to managers and how do you best avoid kind of greenwashing, I would say, look, that's an incredibly important question. I completely agree with Charlotte. Speaking to the fund manager themselves, how do you think about this? What's your investment process? What are your engagement examples in terms of sort of where our focus on ESG integration is all about financial outcomes, and we are thinking around the valuations impact and so on. So it may be that if there is a high risk ESG stock in the portfolio, that could happen, right, in kind of a non-ESG product. But where it's important to think about that is, how has that been factored in? Has it been factored into the overall investment case? And so thinking about that, and that's really our focus of the style of ESG integration is all around that. And now I think more broadly in terms of transparency, the industry is on a huge journey on transparency. There's the new UK stewardship code that's coming out in the UK. It's a hugely important piece of work in transparency. The amount of detail that is now going to be required from, every asset manager that signs up to the code, and actually, being part of that code already is an important sign, I would say, in terms of kind of greenwashing and ability to actually take these issues seriously. So I would say, watch this space. Everyone in the industry has to report by March Q1 next year, and I think a lot of people are going earlier than that. So I would say, early next year, watch the space and review those reports, because I think that's a really great starting point for understanding what a company is doing around ESG integration, and really the code has been designed to avoid greenwashing. It goes into a lot of detail, and you have to apply or explain. So if there's an area that you do not do today, that's fine, but you have to explain why that is and where you are on the journey to get there.
Okay, great. Ewan.
Yeah, well, what is greenwashing? It's a mismatch between what we're promising clients and what we're delivering to them. So I think there is no substitute for advisors actually doing the work and understanding how ESG integration is carried out and what it results in terms of portfolio outcomes. So we have many mandates where we naturally exclude stocks from it because they're not part of a specific universe. We're being tasked by clients to do particular things, either along ethical or SRI or impact lines. So just to emphasize the point, active stewardship, which I think we're talking about, does not automatically involve exclusions. But exclusions are an important point of escalation. So if we do engage with companies as part of our ESG integration and we're not satisfied with the result, we have a number of things that we can do. And at the end of that spectrum of activities, we can exclude, through choice, companies from investment portfolios because we don't think that they're taking their responsibilities seriously enough and they're running excessive risks with our clients' capital. It's probably a rare outcome of that process, but it is an outcome.
Interestingly, a question's just come through saying after the Boohoo scandal, there was a lot of, but we knew that. Should there not be an onus on groups to say something when they spot issues to drive change? I said, what we're hearing is you'll usually say that behind the scenes rather than publicly, or will you say it publicly?
Saying things publicly is part of our escalation strategy, and you will have seen that in the past. The examples I can think of, which have been very public, is we made a proper fuss about Jeff Fairbairn's pay at Persimmon. Mm-hmm. Now, the way that the company responded to that was entirely productive and progressive, and there was a lot of work that went on behind closed doors with the board. The board ended up appointing a new chairman. That new chairman ended up concluding the relationship with Jeff Fairbairn as a result. So there was a lot of change that happened publicly as a result, but you typically only see the tip of the iceberg in terms of the activity levels that lie behind significant corporate events like that.
And Charlotte, do you adopt the same approach at Janus Henderson?
So we don't sort of adopt the approach that at a corporate level we will have, a view on something. As our team is sort of there to work with all the investment teams who individually will, if it's voting, for example, at a company AGM, different teams might have different approaches. So we work with them in order to sort of identify what the priorities for them are. But very much, would echo what Ewan says in terms of the collaboration between a company and us. If there are issues that an investment team might have with a company, would be to raise those with them and work with them together to try and resolve those.
And do you vote as a business as one, or might you have different groups of fund managers with different objectives, different client types who can interpret or act as they see fit? So
we have a sort of regional voting policies, but at the end of the day, it is the fund manager which sort of takes the ultimate decision for their voting outcomes to be appropriate for their clients.
Okay. Another question's come through. So do we need to get better at highlighting differences between sustainability and impact for the end consumer? E.g., obvious example of owning Tesla as a stock. Catherine.
Yes, and I think, look, that is a great question. The Investment Association has been very active on this. That there's now a new responsible investment framework that seeks to define, more clearly, I guess, what different products and solutions do, and that that it is across the spectrum, and that will also be, the intention is to also do a label. Certainly, the British Standards Institute is developing one, so I think it'll be a lot more in future, a lot more clear for retail investors what kind of falls in which buckets and how to decide. I would agree with you, and at the moment, the advisors are an incredibly important partner in that, and education around what the different products do, what they don't do, is a really important starting point, and a label. And we've seen this in other jurisdictions. In Belgium, there's something called a Fabelfin label, and that is an incredibly powerful starting point. But it is only a starting point, because there will still be within those labels, a spectrum of options.
Yeah, and I'd be remiss of me, and forgive me, but at Square Mile, we try and do something similar to the IA in providing a framework so that people can broadly see what everybody's doing. Ewan, the questioner mentioned Tesla. We can't let that go past without comment. Would you comment on Tesla?
Well, I haven't bought one, if that's what you're asking. Not yet, anyway. Yeah, so you have a mix there of a fantastically innovative product produced in a different way to the way that mainstream auto manufacturers behave. But you have some governance risk. There's absolutely clear. The governance arrangements around Tesla are peculiar, to say the least. And it's an interesting way of looking at any investment prospect. It's rare that you will find one aspect of an investment which will completely guide you to buy or sell the shares. So if I think about our approach, the integration of ES and G factors into the investment decision, they have to be material to the potential outcomes to our clients for us to apply serious resource to them. So in the case of Tesla, they certainly pass muster on the environmental credentials, but you then need to consider how the governance arrangements are going to affect the outcome. And that is difficult, A, to quantify, and then B, to calibrate in terms of when the governance arrangements might start to either benefit or hurt you. So it's a difficult thing to build into your cost of capital in assessing what the returns profile will be, but that's our job as investors. That's what we have to do. Now, it's been fantastically successful so far, but if you look at the market cap of Tesla compared to all the other auto manufacturers in the world, is that appropriate? So you then need to assess value as well.
Okay, thank you. Ladies and gentlemen, we've got just under 10 minutes for anybody who wants to submit any last minute questions. Another question here, I'm going to direct this at you, Catherine, sort of with what options exist for equity and fixed interest in the passive space? So let's take that thinking about for responsible investing.
Well, so the passive space has grown tremendously in terms of ESG options. There are a whole range of various solutions out there, and they do vary from, kind of the spectrum. So S&P 500 ESG, for example, sort of your very mainstream equity index, but that has an ESG tilt to it, all the way to, green bond indices out there. So it's sort of, it does go across that spectrum from very broad ESG adoption in a very core index all the way to very thematic, very, ESG sustainability, thematically focused outcomes. And with that spectrum comes a whole huge range of kind of tracking areas, risk profiles, universes, exposures that need to be considered as well. But I do, the ETF space does have that whole range, both in the core, equities, but also on the fixed income side. And I do think, the ETFs do offer a very neat, easy solution for certainly that broad exposure is fairly easily applied in kind of an index ETF format. And then obviously it's very important to have the active stewardship and ownership on top of that. And I would just say for Invesco's standpoint on our equity indices, what we do is actually leverage our active fund managers. So to the extent that our active fund managers engage or, in collaboration with the ESG team, takes a position on an issue, our passive funds actually amplify that vote from an equity standpoint. So I do think, we shouldn't say, it's passive and therefore it's not, there isn't any stewardship activity. Absolutely, there has to be stewardship activity also on the passive side.
Okay, Charlotte, any views on from you on passive investing for this area, sustainable investing for equities and or fixed income, or anything you would urge people to look out for?
Sure. So I think the ETF space in this area definitely serves a purpose. I think particularly for if advisors have clients that identify a particular sort of ESG theme that they are passionate about and want to invest their money in. So there's a lot of climate ETFs. There's some social ETFs which tackle various problems, and that will those sort of serve a purpose. Those products to try and cater to lots of different preferences for advisors' clients. I think, we're broadly mainly active here. And so I think, to Catherine's point as well, the sort of active stewardship and engagement is a sort of very key thing for our portfolio managers and analysts and my team as well, is engaging with the companies from the sort of active management point of view.
Okay, thanks. Ewan, what we're hearing today is the embracing of understanding ESG in investment processes, increasing supply and demand for funds with responsible objectives. And does this challenge the way people build portfolios if they build them by asset class and by geography? And does it challenge the traditional benchmark indices that people use? Do you see a change in that coming for the next 5, 10, 20, 30 years?
Yes, I do, potentially. I think the biggest change, though, is actually in the input to the investment processes, Richard. The outputs can and should be defined by our clients. But what we have the power to do as an investment firm is change the emphasis in the factors that are being considered before we apply our clients' capital in support of a particular venture or building or whichever asset class it is that we're investing in. But we are seeing increasing flows, both passive and active, into those solutions that we're developing to try and address climate change, to try to change companies for the better. You're taking a very active approach. And I think our clients, if I was to characterize that behavior, they care more now about how the returns are generated as well as the actual returns. I mean, you have to generate actual returns. That's our raison d'etre. That's why we're here. If we can't promise our clients an attractive long-term return profile, then we shouldn't be in business. But more and more, they're asking us, and rightly so, how are those returns being generated? Are they in line with the mandate that we've tasked you with? And as a result, there are more specialist solutions coming through all the different asset classes and through passive and active and ETFs.
Okay, so we're moving towards we've got a couple of minutes left, moving towards sort of final words. If I go back to how COVID-19 has accelerated the adoption of ESG investing, lots of things you said. It's accelerated the trend, it's increased the engagement, the behavior, the governance, the transparency, help with performance, delivering outcome. There's more stuff to come. Charlotte, this is a final word for the advisors on the audience today. Is it your view that the clock won't be turned back? We've taken a huge step forward, and the world that we're moving into genuinely will be a better world where people are more responsible, and there will be sustainable returns alongside the financial returns, because ultimately they mean the same thing.
Sure, I think, yeah, I don't think there will be any turning back now that we've got this far away. I think the acceleration we've seen has been, albeit during a very difficult period of time, is a really positive thing. I think, I was reading some research this morning about the engagement and from CEOs actually of companies now who traditionally weren't sort of talking about ESG issues. There would be someone else from the company that would normally sort of address those issues. It's actually the CEOs themselves which are really focusing on this, and they realize that it's a very important thing for their investors, and for us as investors it's very important to our clients. So it's something that we have talked to companies about for a very long time, and it definitely won't go away. And I think my sort of other final point was, there's a big, particularly for advisors as well, there's going to be a generational shift of wealth over the next couple of years, and I think certain generations, the mindset, particularly there's been a lot of studies done on millennials, who will be the next sort of, they're inheriting wealth from parents, families. This generation of really do care about these things. Obviously investment returns are important, but I think for them the sort of ESG factors of what they're putting their money into will be very important. So I don't think it's going to go away.
Okay, thank you. Catherine, to you.
Look, I completely agree. ESG is not going anywhere. Having spent more than a decade in this, I've only seen it growing every single year. I would say the COVID crisis has put strong emphasis on the social aspects. I do think there is in terms of kind of focusing that for the future and making sure that we do continue to maintain that emphasis on the social side is something that, the whole industry can challenge itself to do. There has been, from an interest perspective and exponential interest on the climate side. Now, clearly the two are related, but I do think, making sure that we don't lose track and continue to shine an emphasis on the social aspects is something that I'm really concerned about, and something, we really place strong emphasis on at Invesco. So that would be, my kind of final words. ESG is definitely not going away. And we should continue to focus on the social as well as the climate, and obviously the corporate governance aspects as well.
Thank you. And very quickly, Ewan, a final word from you.
Okay, I will try and be quick. I think what the crisis has done for us is caused us to ask the question of ourselves as to what is really important. It's tested our resilience in ways that we probably never imagined in terms of an investment context and a personal context. And I think it's caused difficulties to different levels to everybody across the world, our clients, our investment teams. And it has caused us to reassess the answer to that question. And I think, many people refer to ESG factors as non-financial. And I think part of our reassessment is to judge that these factors are very much financial. They might be difficult to value, they might be difficult to time in terms of their impact, but ESG factors are financial. They are an important part of the investment decision-making process, and we should amplify their importance when we're making these decisions on behalf of clients.
Ewan, thank you. So, ladies and gentlemen, I'm afraid we've run out of time there, but I hope the last 45 minutes or so has helped convey just how serious our panelists and the companies for which they work are about understanding, embracing, and helping clients get their heads around this. The idea of this, you get some idea of the scale of the resource and thought being applied to it. Clearly, how important it is from so many different perspectives, and of course the effect, or dare I say, impact that it has on your clients' investments. Please will you join me in a virtual or an actual, if you're that way inclined. Thank you very much to Charlotte Nisbet of Janus Henderson, Catherine de Koning Lopez at Invesco, and Ewan Sterling from Aberdeen Standard Investments for their times. Ladies and gentlemen, thank you very much indeed. And now I'm going to pass over to the lovely Natalie Kenway for some closing remarks. Natalie.
Thanks very much, Richard. What another fantastic event we've had this morning, with some really engaging debates and analysis of where we currently stand in the investment industry in terms of responsible investing. We've had another insightful advisor panel where Dan, Andy and James talked about their various ethical journeys, They discussed how their clients have different approaches and how one person's values may be different to another's, and how important it is to have that conversation with every client. The polls revealed advisors are unsurprisingly seeing significant increases in the number of clients asking about responsible investment, and at 38% of you expect investments you advise on to be more than 40% focused on ESG in 3 years' time. The advisors also explored the huge range of products asset managers have brought to the market and areas where there might be room for more vehicles, such as region-specific emerging market funds, but also emphasised there is plenty of choice to choose from across asset classes. With so much choice, there is, of course, increasing concerns about greenwashing. Advisors highlighted the critical importance of sticking to rigorous fund selection processes, and I'm sure Andy won't mind me saying he hammered home the point of the importance of education, education, education. The panel also discussed the role of IFA qualifications. As for the Educational Academy, Jake, watch this space. In the Ask the Expert panel, 7am Terence responded to queries on ESG fund selection. Schroders Hannah explained that responsible investing is not just a short-term fad in the wake of the pandemic. And JP Morgan's Vincent shared thoughts on why the crisis has created more opportunities for responsible investing. We were also delighted to be joined by Jenny Davidson from Standard Life to give us the platform view and how she expects platforms to play a more significant role in the ESG landscape, particularly in this digital age. Richard's asset management panel discussed how COVID-19 has impacted how companies are behaving, but also significantly ramped up interest in ESG investing. Charlotte, Catherine and Ewan said the pandemic has brought an acceleration in a lot of ESG trends, with more focus on increased engagement, social impact, and how companies are looking after supply chains and employee mental health, for example. Ewan said that COVID has forced generational change in the blink of an eye. The trends that were already underway, such as the death of the high street and how we use or don't use office buildings, pushed much further along in a short space of time. I think the overriding message has been that how we work and how we live is changing, and therefore investment patterns will change too. Don't forget, ESG Pathway is a series of webinars. The next will be held on the 4th of November at the same time as 10am, and we will be exploring the nitty-gritty of what sustainable investing really means and look at how asset managers are evidencing that. Thank you so much for joining us today, and thank you to our presenters, panelists and sponsors. See you on the 4th of November.